Practices for 2012 webinar. It's the latest webinar for Wilkin Guttenplan series of webinars for condominiums and co-ops. My name is Ed Wilkin. I'll be the moderator for today's session. I'm a shareholder with the accounting firm of Wilkin Guttenplan, who spends a significant amount of time working with condos, co-ops throughout New Jersey and New York. I work with a large number of condominiums, cooperatives, and townhomes, and my experience is in all facets of condominium, co-op, and HOA accounting and consulting. I have a few housekeeping items before we get started. You can use the questions panel in the GoToWebinar dashboard to submit any questions or comments you have as we proceed throughout the presentation. We'll either address them as we go or at the end, depending on the time commitment. We will keep the presentation to a maximum of 1 hour. At the end, there will be a slide with the presenter's contact information should you have any questions after the webinar is complete. A recording of the webinar, as well as a copy of the slides, will be placed on our website, and our website is www.wgcpas.com. That's cpas.com. You can also find recordings of past webinars there as well. Please keep your eye out for additional webinars that will be coming up. We publicize them on our website, and we also send them out via email. Finally, we welcome your feedback as to suggestions for future programs, topics, or comments on this program as well. Moving on, today's program will be focused on best practices that co-ops and condos can use to help them deal with financial challenges they're facing today. Our presenters today are David Byrne and Jennifer Brick of the law firm Stark & Stark, and Annette Murray, partner with Wilkin & Guttenplan. David is a shareholder at Stark & Stark. He is a co-chair of the firm's Community Associations group, where he concentrates his practice in the area of HOAs, cooperatives, and condominium law. He provides HOAs, condominiums, cooperatives with a full range of legal advice and services, including the drafting and negotiation of service contracts, rules and regulations, alternative dispute resolution, that's ADR, collections, transition negotiations with developers, construction defect litigation, municipal services and relations, fair housing compliance, restrictive covenant enforcement and interpretation, any necessary litigation-related services, and the fiduciary responsibilities and duties of board members. Jennifer is the Business Development and Practice Director for Stark & Stark Community Association Group. She has been with the firm for 13 years and works in the New York, as well as Lawrenceville, New Jersey, and Yardville, PA offices. Annette Murray is a shareholder with Wilkin & Guttenplan. She has more than 20 years' experience working with condominiums and co-op housing corporations, providing them with accounting, audit, and consulting services. She has spoken frequently on industry topics, including budgeting, understanding financial statements, and the role and responsibility of board treasurers. At this point, I'd like to turn the presentation over to Annette. Go ahead, Annette.
All right, thank you, Ed. I just want to thank everybody for participating today. We really got a great amount of people logged on, which is terrific. And I just want to remind you to, if you have any questions, to send them in. I'm not positive how many that we'll be able to get to, but we'll definitely try and get to some questions at the end. And if we weren't able to get to your questions, please feel free to email myself or to Dave Byrne your question, and we'd be happy to give you a call or get back to you. So the topic for today, as we're wrapping up the year 2011, and many of the buildings have prepared their budgets for 2012, I thought it would be a great time to talk about some financial best practices for 2012. So I'm not going to be covering budget topics per se. There's a few budget topics I'm going to touch upon, but I do want to remind the audience that the budgeting webinar that Wilkin & Guttenplan did back in October is on our website. So if you do have some specific financial questions, I suggest you take a listen to the budgeting webinar that had been done, and again, follow up with me if you have any questions afterwards. So one of the first things I want to talk about for financial best practice would be monitoring the building's finances. One of the things that we need to emphasize is that the board and not the managing agent is ultimately responsible for the building's financial statements. And I think it's a great idea to designate at least one board member to carefully review the monthly management reports. Then this board member should report to the rest of the board monthly at the meetings as to the highlights of the management reports and any areas of concern that that board member noted. And it could be maybe it's two board members and you alternate who has the responsibility each month, but it really is important that someone takes that responsibility. Some of the items to look for are declining or low operating checking account balances, accounts payable, that's the unpaid vendor bills, which is greater than the operating checking account balance, because again, those two items means that the operating cash is going down, and that's something that really needs to be monitored. You need to check the increasing, if there's increasing delinquencies. Again, if shareholders or unit owners are not paying their monthly common charges, that's something that the board needs to be monitoring along with the management company. The vendor names on the cash disbursements report or in a general ledger report that you get for your managing agent. If you're not familiar with the vendor names and or the dollar amounts don't make sense, you really should inquire of management and get a copy of that invoice to make sure you're comfortable with that expenditure. You also definitely want to go over with your managing agent any significant and or unexplained variances from budgeted amounts, because that could be indicative of a problem that maybe you want to get a jump on early in the year. You don't want to be asking too many questions months after the fact. You really want to be timely with this review. One of the other items that we like to do is to review the bank statements for unusual items, and that the board member should be doing that.
Annette, I wanted to maybe have you embellish on that. What are some items that you should look for on the bank statements or review to be comfortable with what's in the statement?
Right. Well, I guess one of the things I'd first look for is to see if there's any bounced checks. And by bounce checks, I mean, is the building bouncing any checks to vendors? And I'm sure that happens very, very infrequently. But if a board member during the month of review of the management reports does see that the building bounced a check, you really do need to talk to the management company about that right away if it hadn't been brought to your attention already. Because, again, that means that the cash flow is getting really tight. And, maybe it's just something, there was a miscommunication in the management office. But, again, that's something that you really need to understand that right away. If you start seeing that the unit owners are bouncing checks to the buildings, that some of the checks are getting returned more than an occasional event, that's something that needs to be taken care of and looked at right away. And also reviewing the bank statements. If you see any unusual debit memos, what might be happening with that? Unusual bank charges or service charges that you're not expecting, that definitely should get reviewed. All right. One of the other things that should get done is the annual audit. I would definitely designate at least one board member with a financial background to review the draft audit report with the audit firm. Audit season's coming up soon, and the auditor should always speak with at least one board member to discuss the audit. There are some audit requirements that some mandatory discussions take place, and one of our famous ones is, we do ask the managing agent as well as the board if there's any fraud that they're aware of. It's a required inquiry, so that's really important that, there is a good, strong person on the board to have that dialogue and relationship, I think, with the outside audit firm, which, again, will be coming up over the next couple of months. I think another thing that the board needs to monitor carefully is the board member should approve and document in the minutes if any shareholder or unit owner balances get written off, any delinquencies for any reason. Again, this is more, I think, on the condo side than the co-op side. But again, if there's a foreclosure on a unit or any late fees or fines get waived, that the board will have given the managing agent direction to do so, but it really should be documented in the minutes that the board did approve it. All right.
Annette, we have a question, and it's an interesting question that comes up quite often when we go to board meetings. Would it be preferable for treasurers or board members to approve all disbursements coming from CAM?
Yeah, I definitely think so. I mean, I think to any degree, an ideal situation is the board receives the monthly management reports, one of the board members or all the board members review it, and they actually approve the reports and actually document that review in the board meeting minutes. To me, that's the ideal situation, because it's really, again, documenting the fact that the board is taking responsibility for the financial statements and for the financial activity, and that they understand what is contained in that month's financial statements. Due to a lot of reasons, sometimes some board members don't have financial backgrounds, sometimes some of the boards are very, very busy, so they keep thinking the managing agent's taking care of it. But again, the board has to remember that they have the ultimate fiduciary responsibility to take care of those things. Let's see here. Now, I have another question here. As to accounts receivable, do associations have an allowance for bad debt account balance policy? Let's see here. Do associations? Yes, I think some associations, again, this will be on the condominium side and not on the co-op side, because on the co-ops they have liens on the share, so you're talking about two different kind of ownership. But on the condominium side, I think it is an excellent policy, excellent idea for the building to actually have a formal policy for the allowance for doubtful accounts. So again, this is really having a good communication with the management company and with the department at the management company that's handling the receivables. And the treasurer could work with the management company in deciding what that would be. So it could be if once a unit owner hasn't, say, paid for 6 months at all, that maybe 50% gets allowed for, and then you review it at the end of every year as part of the audit, because if it doesn't get addressed on a monthly basis, it definitely has to get addressed on the annual basis. We've got a lot of questions here. Does the board need to approve the budget? Absolutely, almost always, and usually a lot of times the legal documents and bylaws actually say that the board needs to approve the budget. And that actually touches upon the next slide that I have up here on financial transparency. I really think that it's very important that the board creates the tone. And the board, while doing its fiduciary responsibility, sometimes thinks they need to make decisions, which they absolutely need to do sometimes in private executive sessions. But if the board really needs to set the tone that all this financial activity of the building is transparent. If the shareholders and unit owners feel they don't have access to information, then they might begin to question everything that the board's doing, that the board is, quote, hiding things from us. So I think it's great to remind the owners that the annual audit and the monthly management reports, if that's the building's policy, that they're available to them at any time. And some of the buildings actually have unit owner sections of the website, where they sign in, and you can actually have the annual audit up on that. And I think it's just really good that the unit owners feel that they have access to information that they're entitled to. Another important thing is to deliver the annual budgets to the owners as early as possible and make sure that there's a clear, concise reason and explanation to explain why there are common charge increases. And also, as we've been seeing the last few weeks, a lot of the budgets have been going up anywhere from 5 to 10%, the common charges, which is quite large. And they've actually been having quite a lot of special budget meetings, that the unit owners are being invited to, so they can explain why the increases are taking place. What do you have, Ed?
I just want to mention there's a question on here now dealing with high delinquencies. When Dave from Stark & Stark is going to address a lot of these areas, so if I'm skipping these questions now, it's because I expect that Dave is going to cover a lot of these. But one thing I do want to mention, maybe Annette could spend a minute on this, is including in your budget a bad debt line item.
Right, and I'm actually going to be discussing that in a few minutes. Yeah,
good.
So I will be covering that. All right, so again, just to regroup on the financial transparency, the unit owners are entitled to have financial information, and it's just the board's job to make sure that under the bylaws that the members get everything they're entitled to. All right, next I'd like to talk about an investment policy. I think it's a great idea for the board, if you don't have one already, that each association building has a current investment policy, and it should be written. And then this way it gets passed along, and really what it does, it documents the current investment policy, and it also directs the future boards, so that every time the board turns over, you don't have certain board members that maybe wanted to invest in one type of way, and then you have a new board in that says, let's go invest in the stock market. And just on that note, Wilkin Guttenplan only recommends to its condo and co-op clients that they invest the building's monies in investments in which there's no risk of loss of principal. A written investment policy should include several items, such as what the general policy is, the goals and investments, the goals and objectives of the investment policy, what the investment strategy is, what the investment selection criteria is, and some review and control procedures. In other words, maybe as part of the budget time, you could also talk about what kind of investments, what was the return on investments, and I don't think I need to share with most of you right now that, the interest rates are extremely low. There really is nothing great to be putting the building's money in right now other than maybe make sure that the money, if you have it in CDs and T-notes or anything like that, that they're laddered so that the monies are available when projects need to be done. Another area that I think is important is to adopt a written ethics and conflict of interest policies. It really is it is clear that the board needs to act in the best interest of the building, and that's what these policies address. The policy should identify the types of conduct or transactions that raise conflicts of interest concerns. An example would be, if the brother of a board member was one of the largest contractors doing work in the building. That just really raises a lot of questions. Even if maybe a formal bid process was gone through and that contract was awarded to a brother, it really might make other board members uncomfortable and a lot of the unit owners uncomfortable. So that might be something that gets put in such a policy. It also addresses confidentiality issues, so things that get discussed in executive session, litigation issues with the buildings. Board members are really not supposed to take those kind of discussions outside of a board meeting. One of the important things we'd like to suggest is that you really work with your legal counsel to have these policies done. They really are the experts and will help you to make sure that you do everything excuse me, in conjunction with all the rules. And again, the policy should be very clear and concise, that there's no gray in there. Again, there are always areas that are subject to interpretation, but you do want to make sure that the policy itself is not confusing to board members and to the unit owners. Another great thing I think is to have going forward, if you don't have one already, is to adopt a written document retention and destruction policy. As you know, many of the buildings in New York and some of the communities in New Jersey have been around for many, many years, and a lot of times the boards change over, a lot of times the management companies do change, and what has happened to the past year's documents and records, what needs to be kept. If anybody's interested, you could email me, and I'd be happy to share a document retention policy with you. But there are definitely certain documents that have to be maintained permanently, such as tax returns of the building and payroll records. And the board should really know what the managing agent's storage and retention policies are. So this way you know where your building's records are. And if you do change management companies for any reason, where are the prior records going? You really should be an understanding of that. Then, as you know, every board member keeps their own files and records. I mean, that's very important. The treasurers have information, board presidents keep information, and as the board turns over, is there some policy for transferring those records? So the wheel doesn't have to be created for a new board member, but also you don't necessarily want private information floating around the building too much. So some things, considering the old days, a lot of times they considered board books. There'd be binders that contained a lot of information that could be transferred from one board member to another, or keep electronic copies, files that could be put on CD or disk that board members could share with each other.
Ned, I just want to mention, we've had a number of questions regarding collections and delinquencies. And again, I want to remind all the audience that David is going to cover a lot of this areas, and I'm going to pass these questions on to David, and he'll try to answer them when he comes on after Annette is done. So we're not ignoring your questions, we're accumulating them, okay?
Terrific. All right, yeah, I'm making sure that we do give Dave a lot of time, because we absolutely, and I'm getting ahead of myself right now, so, but I'm going to address that in a few minutes. One of the other items that I want to talk about today, and again, it's come up with preparing the budget, is what if buildings have prior year operating deficits? Now, once in a while we see some buildings and associations with prior year operating surpluses. It's not so common. If you do have a prior year surplus, you can use it to offset future budgets. But what we've really been seeing and dealing with, and I've seen it actually quite a bit the last couple of weeks, are current cash flow deficits, which again means that the building probably has previous operating year deficits from 2010, 2011, and they really do need to get dealt with. So as the year goes on during 2012, if you see that your building is running tight in cash flow, when it comes time to prepare your 2013 budget, you really do need to deal with that shortfall. It can't continue to grow every year. And one of the ways that you can tell that you have one is what you do is you look at your 2011 audit, or if you want to pull out your 2010 audit right now, look at your prior year's audit and current management reports, and look at the difference between the checking account balance. Now this is the operating account balance. Look at the difference between that and what the current unpaid vendor bills are. And if you have a large shortfall there, then the building is probably likely having some, cash flow issues, or just the vendor bills are being stretched out, farther and farther. But that can't continue to happen every year. And the only way to remedy that really is to get, fresh cash into the building. And usually the best way to do that when it's an operating deficit is to put a line item in a next year's budget and recoup some of that. And we really suggest to recoup that over a 2 to 3 year period. One of the things you got to watch for is that you're not transferring money from the reserve fund to pay operating bills, because that will also catch up with you. And you really should not be going to lines of credit to be paying operating bills. I mean, that also causes problems. Ed's got something here.
I saw a question that came up that is kind of good maybe for you to mention, Annette, and I can comment on it a little bit too. One of the questions that came up is, in a building or property that has special assessments, do banks look down on at a building or association that has numerous special assessments?
Right. Well, there's two ways to address that. One is, for our New York audience, Manhattan and the boroughs typically are used to operating with capital assessments. Again, that's a very common way in which they do their capital improvements. But I think we're starting to see, because of the difficult economic times the last few years, that some unit owners don't have the ability to pay the capital assessments, or at least pay them timely, and the mortgage companies are aware of that. So what we have seen is some of the mortgage companies are getting a little bit more concerned about a building that has a lot of capital assessments. And because of the Fannie Mae requirements, which I'm going to talk about in a few minutes, the FHA requirements, the buildings are asking more and more about reserves. So, I think that.
Yeah, well, one thing to add on that, banks are more concerned about boards that don't act when situations come up. So if boards are reluctant to, for instance, in New Jersey, we have had a couple very, very bad winters, I guess Pennsylvania as well, the last couple of years. And some boards have elected not to go out and do an emergency assessment for that. Instead, maybe they'll underfund their reserve account or drop the services in other areas. Banks will be more interested in seeing that the boards are acting proactively and going out and dealing with that right away and assessing. So again, banks don't like to see losses. They don't like to see continuing losses year after year. So if they're seeing a board that's being proactive, that's a good thing.
Okay. I think next what I'm going to cover is, so we talked about the operating deficits. Next I'm going to talk about reserves. And in New York, reserves is a very hot topic. We've been attending a lot of annual meetings, a lot of budget meetings, and it's coming up tremendously how to deal with reserves. In New Jersey, reserves are handled in a much different way, and I'm really going to cover New York right now. But we have reserves is how much cash that the building has on hand for capital improvement projects, and then we're going to talk about funding for the capital improvement project. So a question we get asked almost daily is, how much should there be in reserves? And I covered this a little bit on our budget seminar back in October. There's a lot of rules of thumb that get passed along out in the industry, and that's not something that we recommend, but some of the rules of thumb is that there's a certain number of months of common charges should be in the reserve cash accounts, for instance, 3 to 6 months, or maybe there's a certain amount per unit, $1,000, $5,000, $10,000 per unit. But if the board doesn't know what capital improvement projects they need to do over the next few years, how could they possibly know whether any of those dollar amounts are right? So what we really feel strongly about is to have a 5-year capital plan, and I'm going to talk about that in a minute. One of the things that could get done is, in order to fund for reserves, is maybe to consider a line item in your 2013 budget, and I'm going to talk about that some more. But in regards to the FHA requirements, some of you might be familiar that the FHA has implemented a couple of years ago, and it's really coming to fruition now in preparing the budget the last couple of years, that they want 10% of the budget to provide for funding of replacement reserves for capital expenditures. And the issue is that there really should be a discussion by the board and the management company regarding compliance with this requirement, because some buildings, like if you're a co-op, the co-op and the co-op has to have a large down payment. It's not an issue for the co-op because they're never going to have a unit owner that's coming in with such a low down deposit amount on the unit. But for a lot of condominiums in New York, this really is an issue because they do have unit owners that want to come in with FHA financing. And not only that, some banks that don't have FHA financing or unit owners, the banks that they're working with to underwrite their potential mortgage, they're applying some of the FHA requirements. So it definitely is something that needs to get addressed. And most buildings right now are not complying with this requirement, but it's something to think about going forward into 2012. And again, how do you invest the reserve funds? We kind of talked about that already in the investment policy. Now, for funding for capital improvements, there's a few ways that you could fund for capital improvements. Again, very common is the capital assessment. There's drawing on a line of credit. There's refinancing the building altogether in a co-op situation. There's putting a line item in the budget, which we talked about, and there's a combination of the above. And all these things should be considered. I just recently helped a building, and they ended up using a combination of all these items to take care of some a handful of projects that need to get done over the next 2.5 years that was going to cost them $1 million. And it really worked out well to use all of these. All right, moving on to one of the last topics I'm covering before I turn it over to Dave is funding for bad debts and collection policies. Dave's going to address all the collection issues, but one thing we are definitely seeing is an increasing amount of unit owners and shareholders not paying their monthly common charges. So what we want to emphasize to the board members and to managing agents and the attorneys, of course, is to address these bad debts early and be aggressive early on dealing with them. On the co-ops, there's certain rules for co-ops versus the condominiums, and Dave will be covering those. And he really, is going to give us a really good idea on best practices with the collection issues. So we have any questions here, Ed, that we want to, I know one of the questions that's coming is if there's any reserve funding mandated in New York and New Jersey, no matter what the documents, legal documents of the building might say, or if there's financial hardships. In the state of New York, there is no legal mandate to have reserves, and most of the documents, the legal documents and bylaws in the state of New York don't require reserves. In the state of New Jersey, while under sponsor control, requires that reserves get addressed, and usually the documents in the state of New Jersey say that reserves are required. So you really need to look to the documents to dictate that. So even if there's a building that's having financial hardship, the board really needs to step up with its fiduciary responsibility and address the reserves. And we talked about some of the ways they might be able to do that. Let's see. I think we're going to move on to Dave. We've got some more questions here because we want Dave to be able to go over his collection material and get to his questions.
Thank you, Annette. David, you're on.
Okay. Let's give it a try. What do I do here? Okay. Hi, everybody. I am going to talk, follow along with the PowerPoint. One of the things that we're seeing a lot of is, I would say, we're seeing a lot of clients struggling with abandoned and empty units, and it's really connected a lot with what goes on in the overall economy. And we try to help clients deal with these things. And I think we have some decent ideas as to how to help you guys can sort of work through these things. First thing you obviously want to do, at least in my opinion, would be put a lien, record a lien, file a lien on every unit. It's a passive collection tool, but it's really the bridge, the foundation of anything else that you're going to do. And it really is sort of the focus of any analysis or consideration or decision you're going to make about what to do after the fact when dealing with an abandoned or an empty unit. Without your lien, you're really at a disadvantage and could have other issues as well, which maybe we'll talk about if we have time. Now, the first approach to dealing with a abandoned or empty unit would be trying to get a rent receivership, and the rent receiver flows from a foreclosure, which flows from the lien. Okay, the lien's a vehicle for foreclosure. The foreclosure is a vehicle for a rent receiver. For anyone that's not familiar with rent receivers, it's basically a simple court-created. It's really a court-created process by which a person is appointed as the custodian or the controller of a unit, and then that rent receiver has the power and the ability to utilize that unit to generate revenue for the condominium, for the association, for the building, whatever the case may be. You want to first, I'm having trouble with my pointer here again. Okay. You first sort of, before you're moving with this approach, and I really have sort of three approaches to deal with abandoned and empty units. This is really the first one. Unit status, identify receiver. You really want to get a feel first for what the unit is like, if you can, or what it looks like on the inside, on the outside. If it's going to require a lot of investment to get the unit to a position where it can be rented, that might not necessarily be a good thing. You also have to identify a receiver, which could be, depending on the state and the jurisdiction, an attorney. It could be the managing agent of the existing building, could be someone else, a local realtor, etc. It's all flexible in that regard. In an existing foreclosure, you file a motion, very simple, asking the judge to create the receivership. Once you have the receiver created, you essentially have control of the property. If the property is empty, abandoned, the receiver then has the right to enter the property, change the locks, clean it up, paint it, and then rent it. Advertise through the newspaper, through realtors, whatever the case may be. The focus would be to take the abandoned and empty unit and now make it an asset or an income-producing asset for the association, for the building, and also making the unit and or the property no longer subject to deterioration, squatters, those types of things.
Dave, in that respect, since you're still subject to a foreclosure by the bank who might have the mortgage on that unit, I assume that the lease that you might establish is going to be somewhat of a short-term or a month-to-month lease?
Well, it's interesting because it's actually sort of the opposite to that. You would think that your lease has to be subject to something, but in reality it doesn't. In order for you to rent the unit, you're really going to have to provide leases that extend beyond a short-term time, or no one's really going to be interested in them. What happens via the receivership is you have the court authority to do what you want to do with the property. So if you have a tenant and 9 months later, Goldilocks and the Three Bears story, a bank shows up knocking on the door and says, who's been sleeping in my unit? The tenant is protected by virtue of a bunch of different state statutes and federal statutes that protect third-party occupants of foreclosed units. And there are a bunch of different things that banks will do or not do in relation to those tenants, but we're able to manage that and typically don't have a problem with that. Fortunately, which is sort of connected to a lot of these things, is fortunately, to the extent a bank actually finally gets around to doing a foreclosure or completing a foreclosure, sufficient time has gone by which the association, the building, may have generated enough revenue to cover its receivable, cover its debt, thereby not being concerned at all when the bank shows up, which is all the more reason why you have to act quickly on these things, which we'll talk about in a little bit.
Thanks, Dave.
Yeah, sure. This is sort of like a having two good shortstops, which I sort of call the good problem to have. When you start generating rent and dollars beyond what is owed to the building and the association through this rent receivership process, which, believe me, does actually occur. There are specific rules that I advise clients to follow when dealing with this good problem of generating revenue beyond what the receivable is. Some receivers are better than others in managing that, but it's certainly something that has to be considered, but it's a good thing, not a bad thing. But you will see that to the extent that you're able to utilize this strategy, you will very often see revenue generated in excess of what the original balance was, even accounting for the fact that you're paying the ongoing monthly common charges or assessments. Let's talk about the next sort of approach to this. This is a sort of an offshoot, if you will, of the rent receiver process, but it's a way to bypass the rent receiver process altogether, which of course means that you bypass a lot of legal fees. But it is not available in all instances. It's essentially, as you can see from the PowerPoint, the owner's assignment of possession and or occupancy rights. You're essentially getting the owner to give to you as a building, as a condominium or what have you, the right to rent the unit. and you don't need a receivership. You don't have to report to the court. You don't have to do anything. It's a deal that's made in that regard. Typically, you see this in a couple of different situations. You see this when an owner, as you can see from the topic, has abandoned the unit, but is still subject to legal obligation to pay, which essentially is until the bank finishes a foreclosure, which we all know means that it could be years as to how long a bank takes to foreclose. So an owner, potentially after filing a bankruptcy or otherwise, being a normal American person, feels that if they've left their property and they don't pay their mortgage, they are leaving, they have no intention of paying the condominium or the association, and they are moving away. But the condominium and the association, the building, still have the right to get payment from them, and so you chase them and sue them and make their lives miserable. They have an incentive at that point to create an arrangement with the building or the association whereby the building and association give up the right to ever go after them again for those assessments in exchange for their assignment of their rights to rent the property. We're not talking about a transfer of ownership, because in most cases the bank still has a lien on the property, as do other people or companies. We're talking simply about a trade. We will no longer chase you and make your life miserable because you have to pay our common charges and assessments. And in exchange, you will give us the right to rent your unit. We will never call you again, and everyone will be happy. Through that process, the association, the building can generate revenue similar to how I just discussed it in relation to the rent receiver. You want to consult your governing documents and your offering plan before pursuing this type of thing. I have yet to see any impediment in either an offering plan or a set of governing documents, but it's important to have that review be done before the building or the association sort of assume possession and occupancy rights. The owner's rights and duties, this kind of flows from what I said before. You are essentially giving the owner a free pass. You're telling the owner that I know you still own the unit, and I know you legally have to pay my monthly common charges or assessments, but I'm not going to come after you for them because I'm going to get money from the tenant, which will be the association's building rights and duties. We have the right then to rent the unit, possess the unit, do whatever we can with it. Of course, as a result of that, the association, the building, becomes a landlord, and so it has a duty to be a landlord. But hopefully the rent is sufficient enough to cover whatever annoyance that may be. And
we have a question that's kind of pertinent to this area. For homes that are being leased and the owner's not paying assessments, so does the board in New York and Jersey have the ability to have a receiver program where a receiver is appointed by the court and collects all rents, which is then forwarded to the association or the building?
You'll love this answer because it's non-lawyer, which is yes. The answer is yes. And in fact, to the extent the unit is occupied by a tenant already, it is even more of a strong target for rent receivership because you don't have the practical issues of finding a tenant, and you don't have the delay in relation to finding a tenant as well. Now, there's also a question with respect to mortgage company. With the mortgage company typically having a first lien on a property, can that mortgage company, can an HOA, can a condominium or a building still secure a receivership? Another non-lawyer answer is yes. The bank's position is irrelevant. Banks typically, under their mortgage agreements and or state law, have rights to get receiverships. If they choose not to, I guess that's their problem. The next and last sort of way I think is useful to deal with abandoned and sort of empty units, and to some extent, picking up from the question that was just asked, units that might already have tenants, would be what we call the AttorneyInFact strategy. And this you will see in a lot of offering plans or governing documents. You actually see provisions on this, which sort of a lot of practitioners and lawyers don't bother to look for. But this will essentially create a dynamic where you, as the building and or the association, becomes the landlord. You become the owner. You become the attorney, in fact, for the owner, vis-a-vis only the unit and its rental situation alone. So you serve notice on the owner and the tenant as if you were a landlord, and you give them notice. You basically serve notice on both of them, indicating that they're subject to eviction if they don't pay the rent to the building or the association. To some extent, the tenant may pay, but if the tenant does not, then you file an action in either landlord-tenant court, depending on the jurisdiction, or really depending on the judge. And if you're dealing with an attorney that knows a lot about these, you know which strategy works best given what judge you're stuck with ahead of time. So you would do your notice. Depending on the notice, you would have to take action by virtue of a court action in a various different courts. And then once you get your attorney-in-fact order, you then process an eviction similar to if you were a landlord. Now, interestingly, though, you don't really want to evict an existing tenant. You simply want to create a leverage, a pressure point by which the tenant feels obligated to pay you the rent. That's really what the focus is. So when you try to employ this strategy, you typically don't end up dragging someone out of the house or the unit because you want them to stay and pay. Now, in New York, there's a specific provision in the Condo Act which deals with tenants' obligations to pay rent, and we use that as well. That is not available in many other states, but it is available in New York, and that provides some additional authority for this. I'm going to talk real quick about mortgage foreclosures because I think this is really, really important. And any building or association that can really master the whole concept of the banking industry and the way the mortgage industry is working can really maximize its ability to recover unpaid common charges and assessments. And let's talk about this. When a bank forecloses, you really should try to file an answer or an appearance on behalf of the building, the condominium, or what have you. As a result of doing that, you'll get notice from the bank of what occurs in the foreclosure. We have many clients that are incredibly frustrated by the fact that there are banks that are foreclosing and never tell them anything about those foreclosures. There's no legal obligation for a bank to tell you about a foreclosure or what the bank is doing unless you file a court paper by which you have a right to get notice. So without that notice, you'll never probably know, unless you're really an avid reader of the classifieds in various newspapers, you'll never know when a bank actually finishes a foreclosure, at which point the bank is responsible to pay assessments and or common charges. I think it's important that you know that date because the second the bank becomes the owner, you should be hitting them with a notice of obligation to pay. Some states there are lien priorities, certainly in New Jersey and Pennsylvania, and those monies may come due upon a bank's ownership of the property when the bank finishes a foreclosure, and if you do not have an appearance, you'll have no idea, again, that there was a foreclosure, and therefore cannot make a demand of those dollars. Lastly, although you don't see this very much, when you have a unit that has equity, when a bank forecloses, there may be surplus funds. Those funds are available to all lien holders to claim with respect to that particular unit. The bank is entitled to get its mortgage amount paid plus additional costs that are awarded to it by the court. Any dollars paid for a unit at a sheriff's sale above those amounts are called surplus funds, and anyone with a lien against that property has a right to secure those dollars. If you don't have an appearance in the bank's foreclosure, you may never know when there was a sheriff's sale. There may be thousands of dollars in surplus funds that you will never know to claim, and God forbid the owner gets them before you do. Let's talk real quick about bankruptcy, because I know we're sort of running out of time, and I don't want to take up too much time. I think this is somewhat important, and you probably deal with a lot of bankruptcies, but I want to talk about it more so in the context of abandoned units, and then if anybody has any questions, we can sort of go through those. But individuals can file Chapter 7 to Chapter 13. Chapter 13 is essentially a timeout bankruptcy. It's so what people file when they have money and have a job and have a relatively stable financial situation, but they've gotten it over their heads and feel they need a little help. So they're asking the federal court to just stop their creditors, the association or the building included, from chasing them and making their lives miserable. But they plan on paying you, provided you do have done a couple of different things. Chapter 7 is what we call a give-up bankruptcy, and it is when basically people have no money, they have nothing, and they just basically want to give away all their property and all their assets, and they want to be left alone. Importantly, and again, to flow through all of these things quickly because I don't want to run out of time, it is essential for associations, for condominiums, regardless of where they are, to have a lien. Now, in a place like Pennsylvania, for instance, a lien is automatic, so there's no affirmative act that has to be taken by an association or a building. But in New York and New Jersey, there are affirmative steps that are required. And if you do not have a lien against a piece of property and a person files bankruptcy, you could very well lose the dollars that are owed to you. Interestingly enough, if you do have a lien prior to a bankruptcy, it is very likely that you will recover money. A lot of lawyers or other experts in this industry don't really know that, but it is absolutely the case. If you do have a lien against a piece of property prior to a bankruptcy, there are a lot of ways by which you can secure payment. And let's just talk real quick, we'll run out of time. When Chapter 13, there's some things that you should be doing when you're filing. When those are filed, they are the things that the client should be doing. There are adjustments that are required when the bankruptcy is filed. When payments are made after a bankruptcy is filed, they're supposed to be applied to the dollars that accrue after the bankruptcy, not the period of time before the bankruptcy. Applying funds incorrectly while someone is in bankruptcy will constitute a violation of federal law and actually generate penalties. Post-petition payments, regardless of what anyone tells you, when a person files bankruptcy, as long as they're the owner of the unit or the house or the property, they have to pay post-petition. There is no waiver in that, and don't let anybody tell you otherwise. Chapter 7 sort of goes through the same thing what we talked about with Chapter 13, but I want to talk about the last aspect of this in relation to abandoned units, which is the discharge and abandonment. By virtue of Chapter 7, in order to give up all of their debts, meaning that people can no longer chase them, people have to give up their house, their property, a condo unit, a unit in the building, a piece of property, whatever the case may be. Once the person abandons that property, they are no longer able to live there or really do anything with it, and they leave. Now, legally, they still own the property until the bank forecloses, finishes a foreclosure, which is what I talked about 10 minutes ago. So a person could legitimately believe that by virtue of federal law, they have abandoned their property, and therefore they have no obligation to pay the condominium or the association ever again. They move to, I don't know, Oklahoma, and they start a new life, and they feel like they're off the hook. Well, interestingly enough, they're not off the hook. Until the bank finishes its foreclosure, which could be 20 million years from that date, that poor guy is liable to pay condominium, common charges, assessments, all those fees until the day he no longer owns the unit. That is a target for what I talked about before. You should target that type of person to get them to voluntarily assign the unit to the association, to the building, because that person has an incentive to make that deal because they have no interest in the property anyway, so they could care less what you do with it. You could get an assignment of the unit and have parties in there for all they care. They're looking for a way to not have to pay you anymore. Also, what's good about this is when someone files a bankruptcy, they typically hire a lawyer to do it. So even if they have no money, they typically come up with $500 or $1,000 to pay a lawyer. Once they have a lawyer, it's easier for you to negotiate that type of assignment, as opposed to dealing with a pro se who doesn't have a cell phone and you can't email them, and it's real difficult to make a deal. Let's talk real quickly before we finish up about sort of what I call what we call the sort of smart collections process. I think as an association or a building, you should be trying to create a culture of payment, which is sort of a euphemism for two different sorts of things. One is to get people to pay the money they owe you. So that's the bottom line number on your receivable report, on your delinquency report. But it's also important that you focus on procedures and policies that will avoid new debtors, so that you are dealing not with a constant struggle of new people coming online, but creating a way in which you're looking at debtors, but the numbers of debtors are going down, or at least not increasing. One of the most effective ways to deal with that, I think, is evaluating debtors on an individual basis. We try, and we think you should try, to look at each individual debt as a separate and distinct process that requires a separate and distinct strategy. And as opposed to simply pulling out a collection policy that your lawyer wrote 15 years ago when the world was in a totally different place, and focusing on paperwork that flows from that collection policy. I think that's a mistake, and I think that you can hurt yourself by doing that. Remembering that the focus is on cash flow, so you don't always necessarily need to hit on every single owner to have an effective collection policy. You simply need to manage the amount of receivables that you have. So you want to try to reduce the receivables to a manageable level while minimizing your legal fees, and you need a strategy that deals with individual debts that flows from there. There's no doubt that you should be using demand notices, whether they be management demand notices or attorney demand notices, early and often. I don't think it's any secret that if the earlier you contact someone who has a debt, the more likely it is they are to pay when they have money. If you send a debt notice to someone who owes you $300, they may actually pay it, as opposed to when you send them a notice for $3,000 and they would like to pay it, but they don't have the money. So don't delay on these things early on. You can worry about your legal fees and later on, but early you should be sending notices. Non-legal efforts, you should be focused on things that don't require lawyers, suspension of privileges, those types of things, access to various parts of your building or your property. And it's the famous sort of favorite one of a lot of people, publication of delinquencies, which generates a whole host of questions and a lot of issues. It's something to consider for a variety of reasons. You should certainly talk to your attorney or management company or managing agent about that. Some other aspects of smart collection policy. We're going to work together, counsel and management. You've got to make sure you're keeping your accounting correct. If you are making deals with people and agreeing to write off debts, which might be a very appropriate thing for you to do, you need to actually write them off because they're creating receivables and balances that are hurting you in a variety of other ways, like Annette just talked about, FHA certifications and your ability to get loans and all kinds of other things. You're maintaining balances that you've long ago decided to write off, so write them off. Why are they still in your accounting? And then God forbid you don't write them off and your lawyer then is told to chase those dollars and is embarrassed a year later when presented with an agreement by which those dollars are supposed to be written off. This helps to manage expectations of our boards and our management companies and our attorneys. We all want to have the same expectation. We want to get proper accounting records, proper delinquency reports to know exactly what it is that we're looking at, and we can structure our strategies based on that. That flows into sort of application of payments policy. These are favorites of a lot of people, and depending on how they're used, they could be useful, and also depending upon what state you're in, they could be useful. But overall, judges, to the extent you're forced with having to deal with a judge, which hopefully you're not ever forced to deal with, but if you are, a judge will typically look at payments that are made every month and will typically feel that they are payments that are paid to the common ongoing assessments and charges. And your attempt to apply them to a balance from 2007 might make you feel good in your accounting records, but may not really work out that well for you. So it's really something to think about as to how you're applying payments, whether or not you have a policy that's really enforceable, and if you don't, then maybe not spend a lot of time with it. This is a big thing that I focus on a lot with clients, is ensuring compliance with payment plans. If you're going to go ahead and make payment plans with these people, many of whom have no intention or ability to ever comply with them, you need to make sure they actually comply with them so that when they don't comply with them, 2 minutes later you're prepared to go on the offensive. The value in making payment plans with people, in my opinion, is not so much because they're actually going to comply with them, but because they're actually going to violate them. And once they violate them, they have no rights anymore because you've gotten them to sign away their rights when they signed the payment plan. It then serves you no purpose at all. In fact, it's harmful for you to ignore the payment plan once you make it and once it's violated, because you had the legal ability to get all of your money at that point, and if you had not been derelict in enforcing it, you would have had a better outcome.
So Dave, in connection with that, then what you're saying is it's good to encourage payment plans.
Yes, my opinion is that it is, but it is also good and I think proper to encourage payment plans that are signed in writing.
With your attorney.
With your attorney. I'm not suggesting necessarily that the lawyer has to be involved with everything. To the extent that a legal action has begun, I think the lawyer has to do it because you want something filed with the court. And you want judges to sign these payment plans because then the judges will no longer be your enemy when you go before a judge. They'll be your friend because they'll feel they have skin in the game, so to speak. But if you're dealing with a balance, a management company sends a letter and the guy owes $400 and wants a payment plan, I don't think you need to over-lawyer it. That can be done through competent management. Fine penalty-based balances. It's important that you attempt to enforce your rules. Fines are certainly an appropriate way to enforce your rules, but in my opinion, they should not be confused with balances or arrearages. They're not real. Fines are not real money. They're not dollars that have been spent by the building or the association, nor are they dollars that are supposed to come in to pay bills. They're used to discourage or encourage conduct, and once that conduct has been encouraged or discouraged, the fine should be eaten and should be written off. They shouldn't be the basis for some collection action to try to recover the fines. You end up then in these ridiculous situations where you sue somebody for $3,000 in fines because he didn't take his Christmas decorations down, within 2 weeks of Christmas, and then you're paying the lawyer $4,000 to get that money. All the while, the Christmas decorations have been down for 6 months. I don't know who would file that kind of lawsuit, and I can tell you when a judge sees that kind of thing, it's a disaster, and he or she will remember you next time you come in with a real case. They'll remember that you were the knucklehead that tried to get $7,000 in fines and legal fees because somebody kept his Christmas tree decorations out too long. Last thing is use late fees and interest, but use them correctly. It's a good approach to a smart collections program, which is late fees are supposed to be used, in my opinion, for late payments or missed payments, and interest is supposed to be used for continuing balances. I have credit card bills, and if I pay my credit card bill late, which I try not to do, I get a late fee. If I have a balance, I get a late fee and interest. If I pay my credit card bill on time and I have a balance, I don't get a late fee, I get interest. That's how judges look at these things. You should be dealing with interest on continuing balances because the fact that a person is not paying you and keeping a balance is depriving you and your neighbors and your communities of money, but it should not be used as a basis for, for generating a balance. So I know we're sort of running late on time. The last thing that I would sort of quickly talk about is what I think the bottom line is here is that all people involved in the collection process, from when a person does not owe money, the regular people that are paying through the most hardcore debtor, that the most important thing is to get boards to be active and involved and really to communicate. You should be working with, a board or a management company or an attorney or all three that have systems in place by which information can be shared, hopefully without a lot of legal fees and other fees involved. But when information is shared and when it's stored in a central location that everyone can have access to, you will find you'll have a more effective assessment and common charge program because you will no longer be scrambling to share information that was probably already shared once before. And with more time, I can certainly talk about how that works even more, but I think we're running out of time, and there's like 50,000 questions being sent in by people. So we're going to sort of go through those, I think.
Okay. I'd like to go to the last slide. Dave, maybe you can forward it up.
This one?
This will give you all the information on Dave's. Annette's information is on the next slide. So if you'd like to copy this down, I'll forward the other slide as well in a second. I'd like to just take a couple of questions and give them to the speakers. If you'd like, Dave, is there a term limit on a lien? Is it good for so many number of years?
It's good forever. In Pennsylvania, you're not required to record a lien at all.
Okay.
In New York, you have to record a lien, file a lien, but you do not have to update it when additional amounts accrue. In New Jersey, which is a good thing for lawyers, as new amounts accrue, new liens are required, or you will be short in your lien numbers.
So that's the reason why you want to do the speed up the assessment and do the full year.
Yes, for the accelerated. That's why New Jersey, has those accelerated provisions, because when you record a lien in March, it makes a difference to be able to include the whole year.
Again, this is probably a question that has a long answer, but I assume that you can get a money judgment also and go after other assets other than the unit once you get a. Is that an alternative you look into?
You certainly can do that. And it's an option that flows. Again, I think I said before, it flows from the particular facts of a situation. I was focused on units that are empty or that maybe have tenants or that have been abandoned. If you have a unit that is delinquent and the owners live there, trying to get a tenant or rent a unit is not an effective approach because the people live there. So you may want to try a money judgment, especially if you have information that leads you to conclude the owner has a job. Interestingly enough, though, in New York, once you have a money judgment, you have a automatic right to a rent receiver. So you don't have to convince a judge that you need one. You simply have to file papers and establish that you have a money judgment against an owner that has property, and all of his or her real property is subject to a rent receiver. So in New York, you can do that, but that's not usual in other states.
I'm going to, there are so many questions, and they're great questions. How about the question, abandoned or emptied units? Is the practice specific to condos or co-ops, or does it work in both situations? Some of the things you talked about today.
Oh, wait, the difference between condos and co-ops?
Yeah, is there a difference if you have a vacant co-op? Does the same apply in that situation?
Well, if you're dealing with a standard co-op where, you know, maybe not an HDFC or a low-income co-op in the city, but a standard co-op, you typically don't have to worry about all these things because the mortgage is, your maintenance fees have a priority over the mortgage, and then the mortgage company has an incentive to pay off the maintenance fees. I think also I wanted to say something too with respect to Pennsylvania and the liens. There's a sort of an argument or an issue with the lien disappearing in Pennsylvania to the extent you don't act on it, meaning if you don't file a foreclosure on it or the like, there still may be a right that the lien will remain for bankruptcy purposes, but you may have an obligation to do something with it.
Well, we have ran out of time. I'm sure with the number of questions that we have, we could probably go on for another hour. And it's great that we had the number of participants and the active participation. I'd like to thank everyone that attended to joining our webinar today, and hopefully you gained some interesting information. Again, you will go on our website if you'd like to rehear the webinar today or any of the other ones that we've done. That's www.wgcpas.com. That's cpas.com. I'd like to thank both Annette and Dave for their presentations, and we appreciate it. Have a great holiday season, and we look forward to talking with you again. Thank you.